Hello, this is the last lesson of this video course, range cycle versus trend cycle. So what is the range cycle? Basically, the range cycle is all about what we already learned in our previous lessons. So what is the range? The range is basically the two QMs on either side to confirm the range. And once we have confirmed the range, what we do? We mark the internal range liquidity, but one time frame higher. So if we are on the 3-minute time frame and we have the range on the 3-minute time frame, we will mark the internal range liquidity on 15-minute time frame. And similarly, if we have the range on 15-minute time frame, we will mark the internal range on the H1 time frame. So just one time frame higher, we will mark the internal range liquidity. And once we mark the internal range liquidity, then what we mark? We mark the DOB and EOB. And external EOB or extreme EOB is here. External EOB we will mark only if we get the change of character, but currently we will mark only DOB and EOB within the range. And where are you in the trend cycle? This is the next one. And after the market takes the internal range liquidity, target the external range liquidity to complete the cycle. So what actually is? Look here. If this is the range, and you know that the range confirms with two QMs. So QM is here and QM is there. And we mark the internal range liquidity. And below the internal range liquidity, what we have? We have some order block. This could be the decisional order block or extreme order block. Extreme order block is always at the extreme. And then we are looking for the price to take this internal range liquidity and then to continue for the external range liquidity and make another breakup structure. So in this case, we say low, high, higher low, and we are looking for what? Another higher high. And when this higher high will confirm, when another QM will form. Once this QM form, then this low to this high will have the new range. Then we have the internal range liquidity, and then we have the point of interest, and we are looking for another breakup structure. So this whole thing between two QMs, internal range liquidity to external range liquidity, this whole cycle is called what? The range cycle. And this is all what we do in our trading. And what about the second part? Trend cycle. But before we go to the trend cycle, we check the range cycle example here. You see that we have the two QMs here and here. And then we have the internal range liquidity. Once the market has taken the internal range liquidity, what we are looking for? Below any kind of POI, we are looking for the external range liquidity. And that external range liquidity is what? The breakup structure. And the second part is my favorite topic, the trend cycle. So trend cycle has basically 7 different steps: the reversal, extension, wedge pop, crossback, base 1, base 2, extension, exhaustion, and wedge drop. So why we need these things? First, we have to understand why we need these things in our SMC trading. Because mostly 99% of people who are the SMC trader, they don't use this moving averages or this kind of trend model, because they only focus on the ranges according to the SMC trading. But I use this trend cycle in the SMC trading to check that where we are in the trend cycle. So for example, if this is the trend and price is somewhere here, based on the SMC, I can see very clearly that these are the ranges. So, and I want to buy something from here is okay. But I still want to see, based on this model, that where we are in the trend. So, for example, if we are in the wedge pop somewhere here, what is my expectation? My expectation is that we are in very early trend. So this is what I see, that are we in the early trend, we are in the middle of the trend, or we are getting into some exhaustion area where we can see some reversals or at least short-term pause. So for example, if we are on the base 2 somewhere here, and I know that I think the market doesn't have too much potential after base 2, and what I'm looking for after base 2, the exhaustion, and this exhaustion may be somewhere from here, and then I'm looking for reversal or at least a short-term reversal. So this keeps me into the trend to understand exactly where we are in the trend. For this purpose, I use 4 moving averages, and I explain how I use the moving averages. First, we check this model, and actually this whole thing credit goes to my mentor Oliver Kell, and he is the US investment champion 2020, and he has a record 941% gains. And this is the US IC investment championship. This is the record. Nobody have more than 941% gains. And these are the audited numbers. These are not like just fake screenshots by someone and say, okay, I'm 2000% up or 10,000% up. It's not like this. These all numbers are audited. And if you want to learn more about US investment championship, you can check online what is this and how these numbers are audited. But anyways, so basically that we never know that what is the reversal extension until we see the first step, what is called the wedge pop. Later I show you on the charts everything, but first we understand everything from here. And this is the most important topic, I repeat again, because I feel that without this thing SMC is not completed actually. So that's why you have to put more attention on this topic. So once we have the wedge pop, the next step is what we are looking for, the EMA crossback. So actually I'm looking for to enter from here or maximum from here. Once I'm in the trend, then the first base, second base, this is basically where the most of the money is made. And then after exhaustion, what we get, either we get another base and then continuation, or maybe we get the wedge drop, like wedge pop and then wedge drop, just like here. And then we have the positive EMA crossback. Now we have what here, we have the negative crossback, this one. And then we are looking for maybe the first base and break, second base and break, and then here reversal extension, and then maybe we are looking for another up cycle from here. So this is how this trend cycle works. And let's see on the charts. I use 4 moving averages for this trend cycle. So you will go to the indicator and you write here exponential moving average, this one. And you need 2 moving averages like this. Go to the setting. The first one I'm looking for 8. And then I use this color. And then second moving average is this color. And this one is 21 exponential moving average. So these are the 2 moving averages and both are the exponential moving averages. The third moving average which I'm looking for is the simple moving average here. Or rather than this one, I will use this by default. So also 2 times. So the first one is 50. And I use this color. And the last one is 200. And I use this color. And I'm using these colors like almost more than 16, 17 years. And think about it, if something I'm using for last 16, 17 years, it means it's worth to use it. Otherwise, if something is not working in your trading, maybe you just think about it, how many things you use and you just skip from your charts just because they are not working. And then you add more things and then you skip those things. Then you add more things if something is not working. But think, if something is working for me for last 16, 17 years, so it means it is working. And I never remove these things. So I think some people, maybe if they are using the free trading view, they cannot plot 4 moving averages like this. So for them, I can give them one study, and it has all 4 moving averages. You see, these are my default, and 8, 21. These are EMAs, and 50, 200. These are SMAs. Okay. So in this case, you have only one moving average, one indicator for 4 moving averages. Okay, so let's talk about the trend. We have 4 type of trends. Number 1, we have the long-term bullish. And then we have the short-term bearish. And then we have the long-term bearish and short-term bullish. So we need to keep an eye on these 4 trends. So what is the long-term bullish? Long-term bullish is when 21 EMA is greater than 50 SMA and 50 SMA is 21 EMA is greater than 50 SMA and 50 SMA is greater than 200 SMA. This is what we call the long-term bullish trend. So what is the short-term bullish trend? Short-term is just a little bit weak, 21 EMA is less than 50 SMA, but 50 SMA is greater than 200 SMA. It looks like a little bit more overwhelming if someone is using this thing first time, but don't worry, it is just one time practice, and then this is forever. You will use this one. So long-term bearish is what? The same thing, but just conversely, 21 EMA is less than 50 SMA, and 50 SMA is less than 200 SMA. So what is the short-term bullish? Short-term bullish is 21 EMA is greater than 50 SMA, but 50 SMA is less than 200 SMA. Very simple, very simple. Okay. So let's see. I turn on the moving averages, and this is what we have, the ranges. So the point is how to connect everything together. You don't need to use the moving averages all the time. You remember one rule I told you in the SMC trading, and that rule is not just come out of nowhere. Everything comes with some logic, and I never explained that logic before because we never reached to this step before. So since we reached this step today, so I will explain this logic today, that why we are looking for X and then we are looking for Y. Okay, so in this case, you will not use these all moving averages all the time, except when I say, you heard many times, when a DOB disrespects, we expect the price to travel to EOB. You remember this concept? How many times I explained even in the video lectures and also in our live sessions, that when a DOB disrespects, we expect the price to travel to EOB. But the question is why? Why the disrespect means we are traveling to EOB? And many times the price even disrespecting but never travels to EOB and then just makes another breakup structure. This happens many times. Now you need to add one additional layer with this thing, and that additional layer is this one. So let's put here. And now we check step by step. So let's say this is the most current price action. Okay, we are here. We have the range from here to here, and the price is at the DOB. And if you are thinking that this is the disrespect of DOB, like I explained you in our previous lectures, that you need to go one time frame higher to see that if it is disrespected or not, maybe 15 minutes versus 1 hour. If you go one time frame higher, this is just maybe the week only, or if not week, maybe one close lower and then the next close higher. So it's not a disrespect. But even if it is disrespect, the thing is that you are not going to blindly follow this concept. You have to put this layer into this area. So let's turn on the moving average and see what I say. Long term bullish, 21 EMA, this red is 21 EMA. 21 EMA is greater than, look here, this is 21 EMA is greater than 50 SMA, and 50 SMA is greater than 200 SMA. So why would you sell when everything is long-term bullish? Think about it. So rather than you are looking for sell here on this bullish range, you are looking for buy here. And then you are looking for another breakout structure. High, higher low, and higher high. So what the point is, look, without moving averages, still you have the structure and you are looking for buy here or sell here. This makes you always confused and also makes you confused. This is the disrespect or respect. Very simple rule. Go, turn on the moving averages. Check the rule. 21 EMA, red color line, is greater than 50 SMA and 50 SMA is greater than 200 SMA. No question. Simple buy. You have the bullish structure and this is not the disrespect. These moving averages is telling you that this is not disrespect. Basically you are sitting on the bullish side. And if you don't want to buy directly from here, no problem. Go one time frame lower and look for the bullish range for the confirmation entry. But one thing is 100% clear, that you are not bearish here. Okay. Let's go and check another example. Let me delete. Okay. Turn off the moving averages. Like I said, you don't need to use all the time. Go to the previous range. So what is the previous range? This one is the high. This one is the low and this one is the high. And after this QM, you are at the DOB. And in this case, this is very clear that this is respect or disrespect. Of course, this is respecting, right? But still, what you need to check, into this area, when the price is here, come here, turn on the moving averages and check what you have. I'm going to turn off the 8 for a while, not explaining the 8 here because I just entered the 3 moving averages here at this moment. So I turned off the 8 for a while. So once you are here, are you in the bullish or in the bearish structure? Look here, you are in 50. Yeah, look here, this is the 50. Let me put here. 50 is greater than 200. So this one is here. 50 is greater than 200. And 21 is less than 50. 21 is less than 50. So you are in short-term bearish trend here. Short-term bearish. It's like bullish and short-term bearish. You are not long-term bearish. You are short-term bearish. So when this short-term bearish turns into longer-term bullish again, you can buy. And what you are looking for? Another breakup structure. So look here. You are waiting here because you are in short-term bearish. You are not going to buy. Price rejected. You are still not bullish. Still not bullish. You are not buying. But look this candle. This is a 15-minute candle. From here to here, this is on the 3-minute time frame, you have a bullish range. If you have learned about the ranges enough, you will say aha, because this is an aha moment, because you have the 3-minute range here, because we are on the 15-minute time frame, that's why you can't see, but you are on the 3-minute range, and also you have the 15-minute turned into bullish, and now you are looking for buy here and targeting what? The external range liquidity. Okay, so rather than you buy here on this confirmation entry on the 3-minute time frame, when the 15-minute also turned into longer term bullish, it's your time to buy. Okay, need more practice. If you are thinking that it's very easy, nothing is easy. You are going to beat Wall Street. And if you think that I just draw one line here and market should come here and bounce and should make a lot of money, and with drawing this line you can beat the market or you can beat the Wall Street, it's not going to happen. You have to do some extra work. And what is the extra work? The extra work is when the price coming into your point of interest. You know, when we call this a point of interest, we call this a point of interest. We never call this point of buy or point of sell. Point of interest. Point of interest means this area is only interesting for us to react. But it doesn't mean to buy or sell. Just a point of interest. So think about it. If the sellers are coming lower and lower and lower and lower, why you think that this is the buy point for you, that the price should bounce off of from here? How you can buy from here when you can clearly see that the sellers are in control? You should wait for the sellers to diminish. When you see that sellers are no more around, then you should look for buy. Otherwise the level is not going to work. Maybe the level is what? Market will just go continuously going down, and you say why the level is not working. Level is not supposed to work. That is just the area of interest. Every level, EOB, DOB, SMT, whatever on the chart, even the moving averages, never expect that level should hold. Your one and only job is, if the buyers are coming into that level, wait for those buyers to diminish before sell. And if the sellers are coming into that level, wait for those sellers to diminish before buy. Otherwise, it is really very difficult to make money in this market just drawing some lines on the chart and think we are going to beat the Wall Street. It's not going to happen. I'm sorry. So what the point is? The point is, you are coming from here. You reached here. What makes you think that you should buy here? Let's turn off the moving averages. What makes you think that you should buy here? Why? Do you have any reason? Just because there is the DOB or there is a rejection block or something, so you should buy? No. Think about it. These are the sellers. These are all sellers. Think about these all last sellers. Look here. So why you should buy off of this level when you clearly see that the sellers are coming in the market? So that's why you need to add, like I said, you need to add one extra layer to check that when these sellers they diminished. So for example, look here, This was the low. The market tried to make the low, failed, but then tried to make the low and made a low. Went higher, came down, failed to make the low. Went higher, came down, failed to make the low. Went higher, came down, failed to make the low. And went higher, came down, and then even went higher. So you don't see that market is changing here, rather like to coming from here to here. Something is changing. Feel the market. You should love the price action like I should say, like your girlfriend. Feel it. That what is her behavior. Feel the behavior of the market. When you will feel it, you will understand, something is happening here. Market made a low here, failed. Another made a low, then failed, and then continuously going up again, right? But how will we confirm? We will confirm with adding an extra layer, which I explained to you. What is the extra layer? Turn on the moving averages, and we are in the shorter term bearish to longer term bullish again. Now, what stops you to buy? Of course, buy. But of course, it doesn't mean every time when you turn from short term bearish to longer term bullish again you buy. You need to check also that do you have enough room for the price to move, and does it fit for your risk to reward or not? If the price is not fit to your risk to reward and just giving you, maybe you enter here, your stop loss is here, it's just 1-to-1, why you should buy? But if this one is here somewhere, it makes sense to buy, right? But setup is there. Setup is there. And I'm not teaching you something new. Everything is according to the structure, but just add one extra layer. Okay. Let's see another example. Look here. You have the range from here to here, and you are at the DOB. Are you interested to sell directly from here? And this is respect or disrespect? Of course, apparently this looks respect, right? But add one extra layer to check. Look here. So what is this? We are here, right? 21, this is the 21. 21 is below the 50, right? 21 longer term base. 21 is less than 50, and 50 is less than 200, but 50 here is still above the 200 but is downtrending, and we are expecting that in next a couple of bars maybe it will cross, and then we will be longer term bearish, but not yet. If not yet, we will not sell here directly. What we are looking for? We are looking for the confirmation entry, and confirmation entry on the 3-minute time frame. In this case, you have the range from here to here on the 3-minute time frame, and when the price reached on the 3-minute time frame, can you see that on the 3-minute range the price is at the extreme order block, and now you can see that 50 even crossed below the 200. Now you are longer term bearish. No question, sell it from this DOB. I don't mean it will 100% work, but there is a setup, 100% back tested setup which makes money. And then what you have, you are looking for at least the 15-minute breakup structure. If you are looking for this one, this range, I mean this range, like I said, this is the 3-minute range. Okay, if not 3 minutes, go one time frame further lower, but you will find the range here. Okay, let's go and see. So this is the low, right? Let's go to the 3-minute time frame. This is what I said. Okay, this is the range, and you see that you don't have the QM in this range. Then you do what? You go one time frame further lower. Now you see that you have the range from here to here, and from here, from this EOB, you are looking for what? You are looking for sell, and this is your 15-minute POI. Okay, you sell here, a little bit worked, then it came back, and then it reached to your 15-minute external range liquidity, and this is a confirmation entry. But when the price reached here or here, by that time you will see that 15-minute also turned longer term bearish. Can you see that? If you entered here, 50 is below the 200, right? I have deleted here. 50 is less than 200 and 21 is less than 50. You are longer term bearish. So what is stopping you to sell here? Of course you should sell. And now you have the setup. What is the setup? You have the range, price is at the DOB, and you are looking for another breakup structure. Just adding one layer extra, you are very much sure that you are what you are looking for, and it has more chance to work. Okay, let's see another example. And if you see that we are going step by step, going back, not just the cherry picks examples. Okay, so what we have? You have the low, you have the high. QM, this is your DOB. Okay, and rather than this is DOB, I will say that this makes more sense. This is your DOB. Okay, so what you are looking for? You are expecting that you are looking for sell here, because you are expecting that, oh, the price have disrespected and now I should look for sell until the extreme order block. This is extreme order block. Why? Because everything is mitigated here. You see, this is mitigated, and then above only this one is available. So you are looking for sell here until here, just based on this theory. But let's add one extra layer to check are we a buyer or we are a seller. Look here. What is this? 50. This is 50 is greater than 200. 50 is greater than 200. But 21, this red one, is less than 50. So you are just shorter term bearish. What is shorter term bearish? Like this, and you are just shorter term bearish, and once the price go back to the longer term, then we buy until here, right? So you are not a seller. You are just shorter term bearish. You are not the longer term bearish. Or let's say you are a longer term bearish, shorter term bullish. Then you wait for the longer term bearish, and then you enter for the shorter term and longer term bearish to get here. Okay. So in this case, you are just the shorter term bearish. Why? 50 is greater than 200 and 21 is less than 50. This is 21 is less than 50. Okay, when you reached here. So what you do? Nothing. Wait. There is no setup. So then what happened? The price exactly reached to the breakup structure, and then it's okay. But when it pulled back, this pullback, now 21, can you see that this red line crossed above the 50? Now you are again longer term bullish. 21 is greater than 50, 50 is greater than 200. What you are looking for? You are looking for a buy, but not on this time frame now. Why? Because you reached to the external range liquidity already. In this case, you go one time frame lower, and now you have the range from here to here. And after take the QM, you check to enter from the DOB and target the external range liquidity. And this makes more sense to you. Why you are a buyer rather than a seller? Because everything is longer term bullish now. Okay, so use these 4 moving averages just at one place, at DOB area, to check the DOB is respected or disrespected. If disrespected, then you look for the EOB. If respected, then you look for the breakup structure. And how we know it is respected? If you are a shorter term bearish only, 50 is still above the 200, but 21 is below the 50. You are shorter term bearish, not longer term bearish. So it means possibly this will be respected at some point. Then you wait. Once you this short term bearish turned into longer term bullish here, that is your bullish trade for another breakup structure. So rather than to buy here, the safest trade is here. And you see that step by step we are going back. Nothing is just cherry pick. This is how you will use the moving averages. And which I explained here: wedge pop, EMA crossback, base and break, exhaustion, extension. I didn't explain this whole stuff. I think the video is becoming too long. At this moment, I'm going to just finish this video, and maybe in some future lessons I will explain that what are the remaining parts, but practice this thing, and then you will understand that how this price action works exactly. Okay, thank you.